Howdy, boys and girls. It's Wednesday, February 23rd, 2022, and this is the Liberty Call. I'm Raymond Dahlman, your humble host. If it's your first time watching, please subscribe and share with friends and family. I would greatly appreciate it. Hope everybody's having a great Wednesday out there. It's finally starting to clear off here in Colorado. We have had nothing but gloomy skies for the last 2 days, and it's not very warm. It's 10 degrees, so if you are not a fan of cold weather, this would probably not be your day. So, but the sun, like I said, the sun's out, starting to melt some of the snow off the driveway. I went out yesterday and cleared some of it, and then it snowed again. So just my luck. And my hands went numb, and it was quite unpleasant, kind of ruined my afternoon. All right, not a very good day in the market. So let's go ahead and jump in and take a look and see how the indexes performed today. The Dow Jones was down 1.38%, closing at 33,131. S&P 500 down 1.76, closing at 4228. NASDAQ down 2.57, closing at 13,037. Small caps were down 2.26. The VIX was up 7.67% today. It's up over 30 at 3102. Again, if anyone who's been watching this for a while knows that anytime the VIX is over 30, that is a real sign of concern. We'll see if it holds there or if it's going to slip back down. I imagine a lot of this has to do with what's going on in Eastern Europe right now. All right. As far as the outside the U.S., mostly red, except for the FTSE 100 out of the UK. And all red till we get down to, where is this? Belgium. The Bell 20 was up. Where is this? Russia, the MOEX was up 1.5%. More red. And then until we get down to the Asian markets, the only Asian market that I see was down was the Nikkei 225 out of Japan. But everything else is green. We, from slightly up to let's see, the SCSE component was up 1.9%. So looks like the Asian markets did fairly well today. European and here domestically, not so much. So not the greatest day in the markets. Again, with all the turmoil of what's going on in Eastern Ukraine and Russia, it's kind of a wait and see what happens. Obviously we've added some sanctions here from the U.S. government with cutting off some of their lending and their ability to trade their debt on the open market, which unfortunately doesn't go into effect until March 1st, if I read it correctly. So nothing has changed at all right now. So that's, and any, say Soviet Russian debt can still be traded on the third-party markets. So, just not going to be able to do initial trades or issues into the American and Western European markets at the time. So, all right, well, let's take a look. This first article, S&P reverses, swings lower as Ukraine-Russia tensions rise. This is written by Yassine Ibrahim from investing.com. The S&P 500 fell Wednesday and remained in correction territory as ongoing Ukraine-Russia tensions forced the broader market to give up its intraday gains. The S&P 500 fell 1.6%. The Dow was down 1.2%, and the NASDAQ was down 2.2%. Ukraine declared a state of emergency on Wednesday as intensifying fears that Russia could step up its invasion weighed on sentiment. Reuters reported that Russia military equipment was on the move towards eastern Ukraine, making a blow to hopes of a diplomatic resolution, just as Kiev appears to be preparing for potential conflict. Reports of cyber attacks that took Ukrainian government and bank websites offline also added tensions. Ukraine urged its citizens to leave Russia and calling up men of fighting age for compulsory military service. The U.S. rolled out further sanctions targeting Nord Stream 2. That's the pipeline, the company tasked with building Russia's Nord Stream 2 gas pipeline. The move follows the first tranche of sanctions announced a day earlier aimed at restricting Russia's ability to raise funds from the West. The European Union, meanwhile, is set for an emergency summit on Thursday to discuss the next steps following Russia's move into Ukraine. The rising tensions continue to underpin oil prices, boosting energy stocks. Beyond the global tensions, a slew of quarterly earnings from consumer discretionary companies, including TJ Maxx, Lowe's, Caesars Entertainment, were in focus. TJ Maxx companies fell 5% after reporting fourth quarter results that missed on top and bottom lines as a pandemic-induced rising costs and supply chain disruptions weighed on growth. Lowe's, meanwhile, paired some gains, but was up about 1% after it delivered better than expected guidance as strong demand for home improvement tools and building materials bolstered fourth quarter results. Caesars Entertainment reported a narrower quarterly loss, supported by a surge in revenue, and as demand rebounded following the easing of pandemic restrictions, its shares rose more than 4%. Big Tech gave up early gains, with Apple and Amazon leading the downside. Chip stocks also gave up its intraday gains, pressured by NVIDIA and AMD, but Intel bucked the trend. Intel was marginally higher after Raymond James upgraded the stock to market perform from underperform, citing limited downside potential. The prevailing bull case on Intel now is that it will finally make some incremental progress on its roadmap, which will arrest and reverse AMD's share gains, Raymond James analyst Christopher Caso said. The S&P 500's trend lower into correction territory has pushed it into oversold territory and to levels that could trigger support. The trading chart above shows the S&P 500 closing on 420 or 4,200 support once again, but in doing so is pressing into oversold territory. Janney Montgomery Scott said in a note, this implies that we're likely to see another rally as the index approaches the 4,200 range in sessions ahead. All right. So all in all, kind of a mixed day. Some companies reporting good earnings, others not so much. All right. And I got three more articles here. They have to do with taxes. So let's go ahead and jump into this first one. It's time to get rid of Social Security's not so hidden tax, written by Brett Arends. In the Social Security double tax, now comes the news that about half of Social Security beneficiaries expect to be taxed on their benefits this year. So reports the Senior Citizens League, a group that represents seniors. The number expecting to pay tax is 49%, it reports. Last year, 47% of beneficiaries said they paid tax. The Social Security tax is a scandal sitting in plain sight. It's a stealth tax levied on middle-income seniors that was not supposed to hit them. And it's an egregious example of double taxation because the people paying tax on the benefits also paid tax on the money they put into the system. Actually, it's worse than that. While your money is sitting in the trust fund, it isn't invested like normal pension money. Instead, it's lent to Uncle Sam at low rates of interest so he can use it for government spending. If the president wants to boost his sagging popularity while helping the middle class and doing the right thing, he should cut the tax or raise the thresholds at which it applies. The critical thing to understand about taxation of Social Security benefits is that it was introduced only in 1984, courtesy of a commission chaired by Alan Greenspan, and the tax thresholds were never indexed for inflation. Repeat, never indexed for inflation. This year, your benefits will be taxed if your income tops $25,000 a year or $32,000 for joint filers. The figure in 1984, when the tax first kicked in, $25,000 a year and $32,000 for joint filers. Some time has passed since 1984 and today. I think it's 38 years? Yeah. During the intervening 38 years, wages and consumer prices have tripled and the thresholds haven't moved at all. As a result, that a tax that hit only the top 10% of Social Security recipients back then now hits about half. It's no coincidence that in 1984, the median family income was $26,000 or around the threshold. Today, it's about $80,000. Unlike other federal income taxes, Congress has never adjusted the income threshold that subjects Social Security benefits to taxation since that tax became effective in 1984. Even worse, when the tax was introduced, it only applied to 50% of your benefits. But today, thanks to further tax hikes introduced in 1993, it goes up to 85% of your benefits, and it does so pretty fast. Once your income tops $34,000 a year or $44,000 for joint filers, you're in the 85% zone. This is no small potatoes. Last year, this double tax or triple tax walloped senior citizens for $41 billion, According to the trustees' latest report, it's expected to cost them $44 billion this year. Worse yet, the Social Security Administration is expecting the tax take to double over the next 7 years and to hit $100 billion a year within the decade. One of the dirty secrets of Social Security is that the government is counting on inflation to bail out the system, and a majority of the reason for that is it pushes people into higher tax brackets, both for payroll taxes when you're working and this tax on benefits when you retire. The argument for taxing 50% of benefits has at least a modicum of logic to it. Your employer technically pays half your Social Security contributions, and they can deduct that cost against their corporate income tax. But that's 50%, not 85%. So the higher rate is simply a racket. Furthermore, when you think about it, even taxing 50% of your benefits is an outrage. It means that you are effectively paying some of your employer's corporate income tax. With stuff like this in the tax code, no wonder it's so much better to be a stockholder than a working stiff for decades. Social Security beneficiaries get no benefit from that, of course, because of the triple tax mentioned earlier. It's about the only pension fund on the planet that doesn't invest your money productively in the stock market, but lends it cheaply to the guy running the fund. So, yeah, it's doesn't seem quite fair that Yes, your employer does pay half of your Social Security contributions, but in the end, that's really part of your compensation package. Odds are, if Social Security wasn't there, they probably would pay that to you. Maybe not in some cases, but employers look at it. It's just a cost. It's a cost for employing someone, whether or not it's taxes or benefits or whatever it is. It's just a cost of employing people. So. All right. Next article here. Taxes 2022. More Americans are eligible for this expanded tax credit. More Americans may qualify for the child and dependent care credit this year, thanks to temporary changes to the tax code. This credit covers child care expenses you paid so you could work or look for a job. If you had expenses for an adult incapable of self-care, including your spouse or adult children, you may be eligible for the credit. American Rescue Plan passed in March 2021 increased the allowable credit and made it fully refundable. It also increased the phase-out threshold. These changes are for this tax season only. Allowable credit has increased. The amount of allowable credit has increased substantially. In the past, the credit was 35% of up to $3,000 in child care expenses for one dependent and $6,000 for two or more dependents. This year, the maximum percentage is 50% of up to $8,000 for one dependent and $16,000 for two or more dependents. A dependent is considered a child under the age of 13 or an individual of any age who is incapable of self-care and lives with the taxpayer for more than half the year. You will need a valid taxpayer identification number or Social Security number for each person you claim as a dependent for this credit. The credit includes out-of-pocket expenses for preschool, daycare, day camps, adult daycare, and nanny sharing arrangements. The care could be at home or outside your home. To claim the credit, you need to complete a Form 2441, Child and Dependent Care Expenses, and include it when you file your tax return. Additionally, you'll need to identify all people and organizations that provided care using a Form W-10. The credit is fully refundable for this year. The credit for this year is fully refundable. This means if the credit exceeds the amount of income tax you owe, you can still claim the full credit. Any credit in excess of your tax liability will be refunded to you. Taxpayers who had a lower to moderate income and no tax liability when they filed their tax return never saw any benefit to this credit. Manuel Dominguez, a senior tax research analyst at H&R Block, said in a webinar hosted by the National Consumers League. But this year, now that credit is fully refundable, they can get that benefit. They can get the benefit of it. The credit is refundable only if you reside in the U.S. for more than half the year. If you were deployed overseas as part of active military duty, you are still eligible. In the past, the more a taxpayer earned, the smaller the credit you qualified for. Those making up to $15,000 a year in adjusted gross income got the full 50% of expenses for the credit before it began to phase out. Under the new law, the credit doesn't begin to phase out until your AGI reaches $125,000. The 50% credit decreases as your income rises above $125,000 and is unavailable for taxpayers with an AGI over $438,000. The maximum credit for employer-provided dependent care using the new 50% rate means taxpayers will be eligible for $4,000 for one qualifying individual and $8,000 for two or more qualifying individuals. If you receive employer-provided dependent care like a flexible spending account, you must subtract those benefits from the allowable credit. So for those who have dependents, you get a little bit of a break on your taxes. So that should be helpful for anyone that falls into that category. Alrighty. And last article here is 4 tax tips everyone should know when investing for retirement by Rhonda Lee. Taxes and retirement, the two go hand in hand to help assure your financial security. According to one expert, here are 4 tools to help you capitalize on your tax savings as you approach and enjoy retirement, according to Rutgers School of Business professor Jay Soled, who spoke with Yahoo Finance. Catch-up contributions. Both pre-retirees and those who just retired can make bigger contributions to their retirement accounts. Those 50 and over can contribute an extra $1,000 to their IRAs and an extra $6,500 to their 401ks if they're still working. This results in significant dollar savings, Soled said, because if you're taxed at a marginal rate of 30%, this means thousands of dollars in tax savings. So every pre-retiree should consider this, Soled said. And when you're retired, this should be a financial bonanza if you make these additional contributions. Standard deduction or itemize. Itemizing deductions used to be the way to optimize your tax savings. However, the standard deduction is so robust that about 80% of people in the country do not itemize but take the standard deduction. Taxpayers 65 and older can get an even larger standard deduction. Single filers get an extra $1,750, and married filers get an extra $2,800 towards their standard deduction because there's a $10,000 cap on writing off state and local taxes. Unless retirees are making significant charitable contributions of $30,000 plus, then the standard deduction for most retirees is the way to go. Charitable contributions. This year, if you gave cash to a charity, you can take the standard deduction and still deduct up to $300 for single filers and up to $600 for joint filers. Additionally, any retiree who wants to make a robust contribution to a charity can give up to $100,000 from part of their IRA, and if they don't have to report it under the 1040. Soled said, noting that this contribution can also double as your required minimum distribution that you must take from your retirement accounts when you turn 72. And lastly, think about heirs. The pandemic meant some people tapped into their assets to manage financially, especially if they ended up retiring early. However, tapping into certain assets might trigger tax burdens for heirs. Most people, to the extent they have liquidity, should not tap into their highly appreciated assets because under current law, there's a rule that upon their demise, the tax basis is equal to the fair market value. Soled said, just tap into bonds, cash, and other investments that are not appreciated so that heirs have a much lower tax burden. All right. So that's everything there. Some good tips as far as catch-up contributions and what you can do as far as, charitable and passing things on to your heirs. What they were talking about there at the end about the step up in basis. Let's say you had, Exxon stock that, you've had since like the 70s and your cost basis is practically zero and the stock is, it's trading at today, let's say $50 a share. If you were to sell today, you'd have this huge gain on all of the, you'd have to pay taxes on that gain from, let's say your cost basis was $5. So you'd pay taxes on the $45 in gain versus if you were to pass that on when you pass away, whatever the price of the stock is on the day you die, that's the new basis for your heirs. So let's say it's your basis, the day you die, it's $52. And then the day your heirs finally get a chance to either reallocate it or sell some off, it's $50. They just took a $2 loss. So that's actually a good thing. In that scenario, it's not taking losses isn't great all the time, but in that scenario, you wouldn't have any taxes owed. So, all right. Well, that's everything I had for today. I hope everyone has a fantastic Wednesday evening. Let's hope we get a little more sunlight and it warms up a little here. I think we'll finally get above freezing on Friday or Saturday. So I think we even have a 60-degree day late next week. So looking forward to that. I don't mind the cold, but when it's below freezing and below zero for days on end, it does start to wear on you a little bit. So, all right. Well, hope everyone has a great day. And if anyone needs anything from me, don't hesitate to shoot me an email or drop me a phone call. And I will be back tomorrow. Bye.